Hi, I understand that there is this renewed interest around Chinese equities just recently, especially when it's the time of the year again, where we see huge fluctuations around the basket of equities, and you can probably argue that they are currently more volatile compared to cryptocurrencies. But I think that's besides the point. On Monday alone, I think you can see that the Hang Seng Index was down at least 6 to 7%. The Shenzhen and Shanghai Index was down around 2 to 3%. And even KWEB, which is the Chinese tech ETF, was down a good 10-15%, if I remember correctly. So then begs the question. Investors around the world will be interested to know whether is this an opportunity of a lifetime or is this the end of China? So of course, I understand that there are many eyeballs following all these different Chinese equities, and I've received many constructive feedback along the way. So I think I just wanted to take some time to sit down with you guys to walk you through my thought process and some of the observations that I've distilled over the last few days when I was reflecting my current investment journey thus far, and to really look through what I've learned and probably share it on the internet as well. Besides, this is my YouTube channel. I get to say whatever I want to say. But before we begin, of course, remember to help smash that cute little like button so that more people can join in the fun and start laughing at my Alibaba investment. And it has been abysmal if you haven't noticed already. For those of you who are unaware, there is actually a limited time bonus in lieu of celebrating Moomoo's 10th year anniversary. So if you open an account and deposit any amount on Moomoo, you get an extra $10 on top of the other welcome rewards, which might be worth up to 190 Singapore dollar if you deposit minimally 2,700. So Moomoo is a great platform for you to trade and also invest in the stock market, and they have been a solid partner for my own investing journey thus far. Currently, I know it's the big tech earnings season, and many of you are losing sleep over it because these big tech companies essentially set the tone for the rest of your portfolio companies. So fear not, in Moomoo's native app, you can actually keep track of all these different earnings via their earnings calendar and be kept in touch via the notifications. Of course, for those of you who haven't signed up, don't let welcome rewards worth up to $200 go so easily. I'll leave the link in the description down below. For my US and also Australian viewers, Moomoo is also running aggressive reward campaigns, giving out free stocks as well. Just make sure to click on the correct link below. Thank you Moomoo for sponsoring this video. But anyway, I think I just wanted to answer some of the core questions that was posted to me time and time again, and to maybe walk you through what I'm thinking about and what are the different assumptions that I have. So first and foremost, the most common comment, or at least the one that is deeply etched in my mind because it's probably repeated a multitude of times in my investing career thus far, is that, hey, Chikeng, you have been so wrong on Alibaba for at least give or take 1.5 years now. So why can't you just move on? So there are tens of thousands of companies out there. Why are you hooked to just one particular company, or maybe just that few companies that I've been talking about? So I think recently I've also been quite vocal about my bullishness on Tencent. So if you look at the Chinese tech market, these two dragon heads, which is Alibaba and Tencent, I have particular vested interest in both of them. So before I even answer the question, I think I'd just like to point out a particular double standard that I've noticed in my own personal capacity. So for many of those people that had expressed this particular comment, most of them are capital allocators themselves. And by being a capital allocator, I mean that they are probably active investors of some sort, maybe not 100% of their portfolio, but they do actively pick stocks and try to time the market as well. And even though we all know that it's in the long run, most of us probably will not beat the market, but I guess we still belong in this special category where we like to take more ownership in terms of our investments, and we like to construct our own portfolio. So being a capital allocator themselves, I believe that they probably didn't do very well over the last 1 year as well, unless you have been shorting the market. So that's besides the point. So if you're to observe and identify many of the stock performance over at least the last 1 year, many of the mega caps, your FANG stocks, has fell at least 20 to 50%. And let's not go and talk about growth stocks or those companies that are not even profit making. So those companies have collapsed even further. So the same question would then be, if you're asking me to move on just because on the basis that Alibaba is down by a certain X percentage, then why not you move on as well, because we are all probably not having a very good time investing in this current investing climate. I think the more interesting part is, when we are talking about the same topic, which is active investing, whether is it value investing or whether is it growth investing, to them, they're a long-term investor. They have a time horizon of 5, 10, 15 years. And all these short-term headwinds, market manipulation or market irrationality will not face them. But that being said, I'm being crucified on a daily basis because I've picked into Chinese tech, I've picked Alibaba, I've picked Tencent, I've picked Meta. And no, the long-term mindset don't apply to me. It only applies to them. So I think I find that quite ironic. So why can you be a long-term investor but I can't? And I think for those of you who have stuck through this entire journey with me thus far, you can probably tell that I'm extremely patient. Too patient for someone of my age. But I don't know to whether take it as a compliment or not, but evidently I've been losing quite a lot of money in this market climate. So don't listen to my advice or don't follow whatever I'm doing because I've evidently been losing quite a lot of money. And for those of you who are stuck around long enough, you probably have a better idea of how patient I am. So yes, let's put that aside. So now, back to this entire idea of investing into individual stocks and be exposed to such crazy amount of risk. So I think in investing, especially active investing, let's not talk about people that dollar cost average into index funds, even though a lot of people like to think that they are extremely risk averse and buying into an index fund is the surefire way to be rich. When I hear people saying that, oh, the 8 to 10% long-term returns, compounded returns of the S&P 500 is risk-free, as a finance student, I actually get nervous for them because I'm quite sure many people that are passively investing in today's market are really under the assumption that the 8 to 10% long-term returns, if you hold out for 20, 30 years, is risk-free. So using the term risk-free, I think it's a little bit of a stretch, even though I don't care whether you have a long-term time horizon or not. It's really this so-called black swan events that what if one day S&P 500 don't return that promised 8 to 10% return. Because at the end of the day, let's not forget, nobody is underwriting the 8 to 10% risk. So even governments can default, and the only real, quote-unquote, real risk-free instrument is the government bond. And like I said, even governments can default. So I don't exactly understand how people come to the impression that the 8 to 10% return from the stock market, even in the extremely long term, is risk-free. Just because the last 100 years of data said so, doesn't mean the next 100 years is the same. I think that's a very big distinction that you should have. And that's a very bad finance concept to have when you think that just putting into an index fund 8 to 10% return is guaranteed and I'll do my projections based on those assumptions. That's fairly dangerous, but that's another topic for another day. So now, I think back to being active investors, because I know and I understand that many people that actually consume finance related content, whether is it on Twitter, on YouTube or other platforms, most of you are active investors of some sort in your own personal capacity. So let me just try to share some parts of my investing philosophy and my understanding of the markets today. So personally, I do believe that the markets are largely efficient. So largely efficient meaning most of the risk and most of the expectations are priced in at any given point in time. But that said, largely efficient don't mean full efficiency. So that's why as an active investor, I try to get an advantage in terms of understanding what other people don't seem to understand. And because of this disparity in understanding and assumptions, that's why when I think it's dirt cheap, other people think it's extremely expensive. And that's where the disparity in terms of valuations and how you purchase stock and why you think some stocks are undervalued while other people think that the risk is simply unimaginable. So whenever you go into a particular position, it's always a risk-reward trade-off. So at the end of the day, you just have to self-adjust based on your risk profile. So if you think that you can't afford to lose that much and you wish to find a quote-unquote more stable and more safer stock, so be it. Nobody is telling you to invest in Chinese equities where they're talking about, oh, Chairman Xi is going to destroy the whole economy and the country and all these different companies. Of course, for me to be an investor into Alibaba and Tencent, my fundamental assumptions are vastly different from yours or those purported conventional wisdom of how they're going to destroy Chinese big tech and the economy is going to collapse and yada yada yada. So if our baseline assumption is different, of course our conclusion will be vastly different as well. So I really don't understand when people on the sidelines say that, hey, why not just move on? You have been proven wrong time and time again, and time again the time frame is probably 1 to 1.5 years. And if that's a long enough time frame for you, then cheers to you. I'm happy for you. Now, just a side note, I just wanted to point out this falling knife phenomenon. And the interesting thing is, whenever the stock market is booming, when we are in a bull market, everything seems to be fine and dandy. It's the best. The growth rate is going to come in and economy is going to be booming. Everybody's going to be spending money. And in a bear market, the reverse is true. The economy is collapsing, the government is collapsing, the business is collapsing. And when you look at a particular point in time, especially when it's a recessionary period, usually the bad stuff compounds exponentially. And as we have all experienced, regardless whether is it around Chinese tech or even Meta platforms or even Amazon, whatever, and whenever the price collapses, the narrative collapses alongside. So I think your job as an investor really is to identify whether is it a short-term problem or whether is it a pervasive problem. And is there any room for a turnaround? And of course, a lot of the discussions around China today, surrounding zero COVID, surrounding perpetual lockdowns, surrounding economic slowdown, surrounding the property crisis, I think all these are short-term problems. So many of the narrative building really didn't affect my fundamental thesis of why I think Alibaba and Tencent will continue flourishing in the Chinese economy. So that's my long answer to the short question on why I'm not quote-unquote moving on. Now, the second most common question or argument that I get on my channel is that, hey, Chiking, I understand that you are particularly bullish on the country, which is China, but being bullish on the country itself doesn't mean that you are rewarded as a shareholder in many of all these Chinese big tech companies, especially when it's in the bad books of the Chinese government today. And I totally agree. I fundamentally agree that being bullish on a country doesn't equate or doesn't automatically refer to you benefiting as a shareholder, because those are two extremely different structures. But I do fundamentally believe that the equities market in China is probably less matured compared to its developed counterparts. But there are still rewards to be reaped if you are able to pick superior companies. And this is a universal truth in all forms of investing, whether is it in developed markets, in the US, in the UK, or in developing markets in China, or even in Southeast Asia. It's the same framework. Buy good companies, let them compound, don't overpay for valuations, and just wait. I think this is a universal truth that many of us can agree on. So when we talk about this country, about China, this mythical creature, because many people like to think that China is probably uninvestable, let me just quote some of this more prominent and more successful investing stocks or equity position that actually reaped tons of rewards for their shareholders. So firstly, around Tencent, which is a Chinese big tech. So Tencent, I think if I'm not wrong, at its highs, it was trading at around 700 plus, 750 if I'm not wrong. And even after today's collapse, I think Tencent is trading nearer to 200, the low 200 range. Even after that, if you were to look at the compounded growth rate of Tencent to shareholders back when it listed in 2004, all the way until today, which is 2022, and just using it or referencing it to its pricing today at $210, they gave shareholders 26,000% return in an 18 years time frame. 26,000% return. So much for the equities market not rewarding shareholders. Next, I think Moutai, which is a liquor company in China, similarly, they were listed in 2001, and until 2022, they returned shareholders a total of 15,600%. And I think around this idea of cracking down on big tech and how this entire big tech industry is going to cease to exist, I'm not too sure whether you guys are still familiar with the 2008 China milk powder scandal. Long story short, because of some treacherous merchants, they started injecting chemicals like melamine into milk powder formulas, and hundreds of thousands of children were affected. There was this huge tightening in the entire dairy industry from 2008 to 2009, and Mengniu Dairy, which is one of those companies that was embroiled in those controversies, they listed in 2004 until today, 2022. They returned a total of around 1,100% returns. So much for the equities markets malfunctioning, isn't it? Like Charlie Munger, even though I understand that some of you might think that I'm brainwashed, but I do see greater value in some of the companies, at least in today's valuation. Of course, if Google or Alphabet or Apple, if they trade at 50% of the valuation today, so maybe Google trades at like $40 or $50 and Apple trades at like, I don't know, $80, $70, then maybe, yeah, true. I will probably try to seek for more opportunities elsewhere. But given today's pricing model and given today's valuation, I don't think the US equities is attractive compared to the China counterpart, which is why I'm still heavily invested. I think at least 90 90% of my portfolio is still invested into China equities. So I hope you understand this perspective. And for the many comments that I've seen online saying that capitalism is dead in China, so maybe I'll reply that statement with a question. So what then do you think produced TikTok? Was it a dictatorship, or was it a state-engineered innovation? And look at how Meta Platforms is performing today. And tell me more about how China's capitalism is dead and how they are unable to compete on a worldwide platform. So that's that. Now, on the third most common feedback, this idea of political risk cannot be quantified properly. So my natural question would then be, really? So what do you think is Alibaba's price representing today in the US or either in the Hong Kong market, or maybe JD.com or Neo? Political price can't be quantified? I beg to differ. I think it's pretty much quantified in the open market. When demand meets supply in the open market, that's how you come up with a valuation and a pricing model. So I don't believe that political risk cannot be quantified. But of course, I do agree that because of the risk and uncertainty behind it, that's why there is this collapse in valuation. And for long-time back holders, it's just something that you cannot square away. Now, on this idea of trying to quantify risk, I would like to refer you to one of the YouTube video where it was essentially a lecture from Howard Marks at the Wharton Business School, where he was talking about how to really understand investing risk. And he essentially debunked how finance measure a function of risk, which is volatility. So there are definitely both sides to understanding investing risk. One is the qualitative side, and then one is the quantitative side. But to me, the quantitative side of understanding risk is backward looking, so it's retrospective, because you are looking at the volatility compared to a benchmark, whether is it an index or whether is it a fund or whatever. That kind of risk is backward looking. However, when we really want to talk about how risky is this investment today, we should always be forward looking. So that's more prospective in nature. And the funny thing is, the risk profile of every single investment today is constantly changing, because every single day, the management team is doing something different. And whenever they engage in a particular activity, the risk profile or the prospective risk, or at least the prospective risk profile of this particular position is morphing every single day. So there really isn't a very hard and fast way of understanding or saying that, okay, Alibaba is much more risky than Facebook, for example. I think it doesn't necessitate that conclusion, because many of these discussions around political risk, mostly they are anecdotal, and mostly it's just people saying what ifs and what nots. So unless it plays out, so many of these quote-unquote risks will be unrealized until it happens. And on the day it happens, then that risk will be considered quote-unquote priced in. So on the aggregate, for investors that are selling Alibaba at this valuation or at this price point, they might be under the impression that, political risk cannot be quantified, so I'd rather not touch that stock. While people on the flip side, which is people like me who are still buying Alibaba at this current valuation and this current crazy times, we are under the impression that the political risk is overblown, or we don't think that this particular risk that is being priced in is reasonable, which is why we find value in the particular counter. So this is the mismatch in assumptions and expectations. And who is right or wrong, I think only time will tell. And at least within the next 5 years, and in the next 5 years, if the quote-unquote political risk doesn't play out, then I'm right. But if the political risk do play out, means that those people that sold today are right. But the caveat is, even if the quote-unquote political risk don't play out in the coming 5 years, does not necessitate that I'm always right, because it might play out in the 6th, the 7th, the 8th year. So I know that my thoughts are a little bit hazy and it's a little bit unstructured, but I do hope that you are able to follow my train of thought. So that's my long answer to the short question of political risk being unquantifiable. Now, on the fourth most common feedback, investing in a dictatorship country is extremely dangerous. So I would refrain from using the word dictatorship, because I think behind the word itself, it's extremely emotionally charged, and people always tend to have a very bad impression and a negative connotation to it. So rather than using a very fanciful adjective to describe a particular country, because at the end of the day, we all know that every country has its pros and cons, and you should make your own decision based on your own investing profile. If you're not comfortable with China, don't invest in China. Nobody is forcing your hand. But that said, I'm quite sure there are many investors out there that are unhappy with an illiquid market, so they wouldn't touch the Singapore market. They might be unhappy with a deflationary environment, so they won't touch Japan. And some investors might also be uncomfortable with a declining empire. So they probably wouldn't touch the UK market as well. So to each its own. I don't think there is a universal truth into understanding that only the US market is the way to go. And I think I just wanted to point out this phenomenon that I've read it previously in one of those economic books. I know it's quite nerdy, but anyway, I think there was this cognitive bias called the Dunning-Kruger effect. So the Dunning-Kruger effect basically means that it's a bias whereby people with low ability, expertise or experience tend to overestimate their ability or knowledge. And I think it works both ways. It can work on me, it can probably work on you as well. So I might overestimate my understanding of China, even though I'm constantly skeptical about it, but that's besides the point. Or on the flip side, many people can also overestimate their understanding of what a dictatorship means or what China governance and China politics means. So I think I'll just leave it at that. I'm not trying to make an evaluation or a judgment saying that who's right or who's wrong. I think only time will tell. And as I alluded in the earlier part of this video, I'm extremely patient, I'm willing to wait it out, and let's see who's right at the end of the day. Now, on the last point, where I kind of categorize them under the miscellaneous, because they are the same talking points that have been rinsed, repeated and recycled since the start of Alibaba's IPO, I think, back in 2014. So we have always talking about nationalization of all this Chinese big tech. You have a complete destruction of the industry, like the Chinese private tutoring industry. Maybe the VIE structure is invalidated. Maybe China is going to invade Taiwan. The economy is going to malfunction because of the property crisis, and also maybe even the population demise. So I'm not going to spend too much time belaboring the point, because I think for most of these pointers, I've talked about them in many of my videos. I've uploaded at least 300 now. So in every single video, I've probably talked and touched a bit about them in some shape or some form. But long story short, I think there are some overlaps in understanding and there are some overlaps in concerns personally, but many of our baseline assumptions and projections are different, which is why we came or arrived to a different conclusion. And I don't wish to belabor the point. So I think just a simple conclusion to sum up the discussion points in this video. If you haven't realized already, throughout this entire video, I've never really talked about Alibaba or even Tencent's business for that matter. And I'm not trying to sugarcoat it. So Alibaba and Tencent's business itself, if you have observed their income statement, their cash flow statement, they have had a lackluster performance over the trailing 12 months. But I think if you were to superimpose it into the greater context of what China is experiencing today, and if my assumption of that is many of the headwinds that China is experiencing today is short-term in nature, then it makes sense to me. But of course, you might think otherwise. But I think in this recent collapse in valuation for all this Chinese big tech, markets today are probably not trying to price the business, but instead they're trying to price the environment. So that's just my own speculation. So before I end, I think I just wanted to give a short shout out to Saga from Stockado. I've collaborated with him before, and recently, despite all the noise behind China politics, the Chinese economy, yada yada yada, Saga actually released a recent video aiming his muzzle at everything money, and he was still dissecting the business fundamentals and didn't really talk about all the shenanigans that is happening in the external environment. And I truly appreciate that. We need this kind of analysis to stay grounded, because at the end of the day, you are still investing into a company and it's contingent on how the company performs. And I'll probably be reacting to that video soon, because I've realized that there are too many talks around all this intangible stuff. So let's get back to more tangible stuff. With that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!